Morena, and welcome to the Dawn Chorus for Friday, the 1st of November. I'm Bernard Hickey for the Kaka. This is my daily podcast, an email newsletter, and now video that goes out via Substack, and it's called the Kaka. I focus on housing affordability, climate change, and poverty reduction as part of the political economy. Today, I wanted to look at the Reserve Bank's latest update on the housing market. It's a new paper that came out yesterday in advance of its financial stability report. Every 6 months or so, the Reserve Bank is required to say how stable the financial system is, and obviously a big part of that now is what's happening with the housing market. Now, some people fear that when you see a fall in house prices, which has been around 20% from the peak in some places, including Auckland and Wellington, 14% overall for New Zealand, that this might cause some troubles for the banks, given that more than 60% of their lending is now against mortgages, as opposed to business or personal loan assets. And the Reserve Bank has given us the update on what's happening with the quality of the bank lending, how many people are behind on their payments, the risk that some people are so-called underwater, and that the Reserve Bank has also looked at what's happening with demand and supply in the housing market and how sustainable it is. The fear is, of course, that somehow a crash in the housing market would flow through into massive losses for banks and cause instability. The Reserve Bank has looked at this and found actually that the financial system is remarkably resilient and robust. And that's because the Reserve Bank over the last decade or so has put in place restrictions on how much banks could lend into the housing market, starting with the loan-to-value ratio restrictions in 2013. They were supposed to be temporary, but obviously have stayed in place for almost all of that period, except for 6 months or so in the depths of the COVID slowdown, when the Reserve Bank decided to remove those restrictions. In a way, it turned into a very useful natural experiment to find out just how important the LVRs were in restricting house price growth, because when they were taken off, prices exploded. And in large part due to growth in demand from rental property investors who were able to use the equity in their portfolios, which had risen very quickly, particularly through 2021 when there was a 30% or so rise in house prices. And they were able to use that equity and to leverage it up to buy more rental properties. And that's because the banks were happy to lend more than 40% of their new lending to people with debt to income multiples of more than 7 times income. These are landlords. And that was one of the factors in the sharp growth in house prices through 2021. Now, since then, the amount of high debt-to-income multiple lending, particularly to landlords, has dropped. And the Reserve Bank is saying that now it has imposed limits on debt-to-income multiple lending, and they are particularly 20% of new lending, no more than 20% can be to landlords with debt-to-income multiples of over 7 times income. Now, the amount of lending into that segment of the market has been relatively low in recent years, particularly through 2023 and 2024, in part because the banks were anticipating the Reserve Bank's restrictions, but also because obviously interest rates were high and were rising. And for a lot of investors at that point, at least, they were facing interest deductibility restrictions, and there were the bright line tests. Now, the Reserve Bank has come out in this paper and said that the removal of the interest deductibility changes and the removal of the bright line test, the long-term bright line test, will increase demand from landlords for new properties and existing properties as interest rates fall. And unfortunately, as that demand increases, we're not going to see the same flexibility of supply you'd need to keep control of house prices. The Reserve Bank says that the government's decisions to reduce the amount of new house building by Kāinga Ora, and also the exit from the markets of a bunch of developers and builders who've gone broke, will mean that when the demand floods into the market, you are unlikely to see a supply response to soften the growth in house prices. So the risks here are that the improved tax situation for landlords, the lack of new housing supply coming in, and lower interest rates could see another explosive surge in house prices. Now, the Reserve Bank has seen this and has introduced a bunch of changes. And I wanted to show you the way that this so-called guardrail works. So what I'm doing here is showing you a bunch of slides. Obviously, that's the title slide. And you can see here that the Reserve Bank's decision from July the 1st to limit DTIs to particularly DTIs over 7 for landlords, that's the dark purple line, the one that has been above 40% through 2021, now down to around 5%. They've limited that to 20%. So what that means is, in theory, you could say the banks could lift that again from 15 to 20%. But of course, the banks don't go right to the edge of the limit. They prefer to have a buffer in place. And I suspect that the demand for high DTI lending from landlords will rise, but not that much, because the banks are themselves somewhat conservative here, but also they know that they don't want to get anywhere near 20%. It's a condition of their banking license. So you don't want to mess with the Reserve Bank there. So that's in effect a guardrail, so that as house prices rise, whereas in the past that increased equity quite a lot and allowed, under the loan-to-value ratio rules, people to significantly gear up. But when you're limited by income growth, that is a particular problem. Now, you may ask also, how fast are incomes growing for landlords? Well, significantly faster than for first home buyers over the last 4 years, in part because rents have been rising quite quickly. You can see that dark line at the top. That is average borrower gross income. It's risen from around $200,000 for a buying landlord to $368,000 over the last 4 years, an 86% increase, whereas the dark red line at the bottom there shows you that gross incomes for first home buyers have risen from around about $120,000 to $151,000 over the last 4 years. So gross borrower incomes for landlords have been rising more than 3 times faster than for first home buyers. And you can see that without that drop in the amount of high DTI lending, the landlords would be in a very strong position. Now, the question is, what's going to happen over the next 4 years? Are the landlords still going to see their incomes grow 3 times faster than for first home buyers? You'd have to say unlikely, given that rent inflation has slowed off with the slowing of population growth from migration, and also you'd have to say that first home buyers are more likely to have similar sort of income growth as landlords. The issue, though, of course, is that's borrower gross income, and the key issue here is disposable income. And of course, for those landlords, they're going to see their disposable income grow faster than for first home buyers because of the tax changes, and also because first home buyers, their disposable income is influenced by the rents they're having to pay. And of course, that's been relatively high. So you can see how difficult it is for first home buyers to get it into the market. It's useful too to look at the Reserve Bank's measures of what they call house price sustainability. Now, You and I might argue that house prices running at somewhere between 8 and 11 times income doesn't sound very sustainable, given that for most of our history up until 2003 or so, you could buy a house for 3, 4, 5 times income. The Reserve Bank, of course, saying that you can service a loan, and if the interest rates are down there, and you spend a large chunk of your disposable income servicing that loan. So in theory, it is sustainable. And when they say sustainable, they're saying sustainable from a financial stability point of view, not necessarily sustainable from any sort of social or political point of view. They don't make a judgment on that. They have created some interesting house price sustainability metrics here. You can see that chart, of course, in the email newsletter as well, if you're just listening to the audio version of this. And you can see that their two measures are around mortgage servicing costs. So that's the capital plus the interest as a share of income. And you can see that at various points that's risen from around about 30% to 60%. And that's what happened in 2021 to 2024. It's come off, of course, as house prices have fallen, but it's still well over 50%. And when you look at the ratio of interest costs relative to renting, so what's the advantage, if you like, of buying versus renting, it's still around 1.2. So, it's 20% more expensive to buy than to rent. Now, at various points in history, particularly from 2015 through to 2019, it was actually cheaper to buy than to rent. And that, of course, is a factor connected to interest rates. The Reserve Bank says house prices are now at a sustainable level. They're slightly more sustainable than they were, but only just. And that's because they take into account the neutral interest rate. So they try to wipe out the effects of interest rate moves in that sustainability measure over the long run. Now, one of the other issues that the Reserve Bank looks at is how responsive supply is to these shifts in demand for housing. And they've published numbers on dwelling consents per 1,000 working age people, just to give you a sense of how much things have improved. And this is a very interesting chart. I think it shows you quite a bit about the history of Aotearoa over the last 20 years or so. And you can see the green line there, a big surge around 2012 to 2015 or so in the number of new dwelling consents per 1,000 people, from around about 4 to 5 to 16 in one city. Now you can guess, of course, which city. It's Canterbury after the earthquake rebuilds. And you can see an increase too for a blue line there from Auckland, from close to 3 per 1,000 to right up to 16 particularly from 2015-16 onwards. And that's the effects of the Auckland Unitary Plan changes. However, of course, all of those measures, Auckland, Wellington, Canterbury, and the red line being New Zealand overall, has dropped off sharply since the mid-2023 period, as we saw interest rates rise sharply, the number of developers fall over, builders go, and more recently in 2024, a sharp drop because Kāinga Ora has been limited in its growth ambitions by the government's review of Kāinga Ora's build program. So the combination here is that we see more demand from landlords, according to the Reserve Bank, and the elasticity of supply, i.e. the ability for new houses to come on when there's demand for new houses, that is still relatively poor. So a toxic combination if it wasn't for the DTI limits put in place by the Reserve Bank. I'm Bernard Hickey. That was today's Dawn Chorus for Friday, the 1st of November. Have a great weekend. Look out for the Hoon podcast, which is coming out shortly. Ka kite anō.